This is the number one mistake I see from new investors. I think this is by far the number one mistake. I see it all the time is going for high yield traps. This is a disaster waiting to happen for new investors. And I think it's a valuable lesson. So if you can learn it right away and avoid that as soon as you possibly can, do not get sucked into high 9% plus dividend yields on companies that are basically deteriorating or melting ice cubes. Now, you can make the distinction between high quality companies that pay high dividends. That's fine for someone who's seeking income. That makes a lot of sense. But if you have a long time horizon, don't be messing around with like 10 plus percent dividend yields. They do exist. If you screen for them, you will find them. And they're just a complete waste of time if you have a long time horizon. We want to own good companies for the future, and yield traps are not something that I want to mess around with.
I remember the GameStop before everything happened in early winter. They were pushing out an 8 to 10% dividend yield. I know a lot of people. I saw a lot of people on Seeking Alpha and FinTwit talking about GameStop because of their high dividend yield. But yeah, boy, that was a scary thing.
The other thing that I would definitely look at just right out of the gate when it comes to a checklist is asking myself really simple questions. And I mean really simple questions. One that requires zero accounting skills, zero investing skills, zero really even business know-how, which is this company obviously great? Can I explain in one or two sentences why this company is great? And is it going to be better in the future? And I know it seems so elementary and so simple. And that was one of the first things that one of the most sophisticated and best investors I know taught me when I sat down with him is he said, people get lost in the weeds really quick and forget that we are trying to invest in companies that are going to be bigger, better, more profitable, have more market share, generate more cash, buy back more stock, and generate returns for shareholders in the future. And if I can't easily say that the company is going to be better in 5-10 years, that's really difficult to invest behind that, because you are right away going into a company potentially facing structural decline, industry headwinds. It's really difficult as an investor to put your capital behind that and sleep good at night. So I would say right off the gate is just asking myself really, really simple questions, and that will yield surprisingly good results.
I believe it. I mean, unpack that just for a second, because I think it's easy. I fall victim to it just like anybody else, but to look at a company and feel like you want to buy it already, and then kind of put those blinders on and not really consider that question, is it great? So what are examples of companies that are not great? Other, you mentioned the industry decline. That's a super big one to avoid. What would be some other examples?
Yeah, it was what I was talking about before, which is pricing power. Up here in Canada, if you look at the TSX, the Toronto Stock Exchange, or you look at the Standard & Poor's TSX index, if you own the TSX 60, you are heavily concentrated in banking, materials, and energy. Okay, so let's throw aside banking, because the Canadian banks are actually amazing profit centers. So let's look at energy and materials. Now, energy and materials, even if you are the best operator, you're the best well-capitalized, you have the safest balance sheet, you still do not have the ability to decide the price of your product. And that is a structural disadvantage. Let's look at a company like Apple. They basically decide what the price of the iPhone is, or this, what we were talking about earlier, $4,000 MacBook Pro I just bought, which seems just completely ridiculous. They decided what it was going to cost in a boardroom. If you think about how advantageous that is compared to a company that has a product and their product is priced based on what the market is willing to pay for it, those two are not equal. So I think that that's really important in terms of what a great company and what a not so good company looks like is, for the most part, even if you are a great capital allocator, you're the best in your industry, if you don't get to decide your own price, like energy and like materials, it makes it a lot more difficult.